Now we're going to talk about the accounting for leasing from the perspective of the lessor. This is, of course, going to be slightly different than from the lessee perspective, but it's going to be complementary. There are three benefits that are available to the lessor, being competitive interest margins, tax incentives, and high residual values. For lessor accounting purposes, all leases may be classified as operating leases, direct financing leases, or sales types leases. The lessor should classify and account for the arrangement depending on a number of criteria. Lessors determine the amount of the rental, basing it on a rate of return, their implicit rate needed to justify leasing that asset. If there's not residual value involved, guaranteed, or if there is residual value involved, my apologies, guaranteed or not, the company would not have to recover as much from the lease payments. Three particular types of leases by the lessor: operating leases, direct financing, and then sales types. So let's talk about some of the criteria for these and how they're classified. Lessors should classify and account for an arrangement as a direct financing or a sales type lease if at the date of the lease agreement, one or more of these following Group 1 criteria are met and both of the Group 2 criteria are met. Group 1 criteria. Remember, there only needs to be one or more. The lease transfers ownership of the property to the lessee at the end of the lease. The lease contains a bargain purchase option. The lease term is equal to 75% or more of the estimated economic life of the leased property. And the present value of the minimum lease payments, excluding executory costs, equals or exceeds 90% of the fair value of the leased property. Those should be relatively familiar. That should make you think back to that lessee side and whether or not we capitalize a lease as a lessee. And then both of the following Group 2 criteria need to be met. The collectability of the payments required from the lessee is reasonably predictable. And there are no important uncertainties that surround the amount of unreimbursable costs yet to be incurred by the lessor under the lease. Sales types leases involve manufacturers or dealers' profits, where a direct financing lease does not. Here we have a nice pictogram that starts with the lease agreement and then runs through the qualifications on how to determine whether or not something is a sales type or a direct financing lease. Lessors may classify a lease as an operating lease, but the lessee may classify that same lease as a capital lease. The primary difference between applying the financing method to a direct financing lease and applying it to a sales type lease is the recognition of that manufacturer's or dealer's profit at the inception of the lease. The profit or loss to the lessor is evidenced by the difference between the fair value of the leased property, the inception of the lease, and the lessor's cost or carrying amount, also known as book value. All leases that do not qualify as direct financing or sales types leases are classified and accounted for by the lessors as operating leases. Let's talk about the direct financing method a little bit more in depth. So leases that are in substance the financing of an asset purchased by the lessee are called direct financing leases. The lessee debits a lease receivable and credits the leased asset account for the present value of the minimum lease payments. I apologize, that's the lessor. Not the lessee. The minimum lease payments can include rental payments excluding executory costs, bargain purchase options if there are any, guaranteed residual value if there is any, and penalties for failure to renew if there are any. So here we have the same situation for Caterpillar that we used underneath the lessee accounting side. And we are going to walk through this illustration from the lessor perspective and the direct financing method. The fair value of the leased equipment is $100,000. There is no residual value. So the amount that's going to be recovered by the lessor through those lease payments is $100,000. This is done via 5 lease payments to be paid at the beginning of the year to yield a 10% return. That's their implicit rate. Let's go to the present value of annuity due, 5 years, 10%. And that gives us a factor of 4.16986. We divide 100,000 by that factor, then we have payments in the amount of $23,981.62. The lease meets the criteria for classification as a direct financing lease for a couple of reasons. The lease term does exceed 75% of the equipment's estimated economic life. Remember, the lease is for 5 years. The economic life was 5 years. The present value of the minimum lease payments exceeds 90% of the equipment's fair value. The collectibility of the payments is reasonably assured, and Caterpillar incurs no further costs. It is not a sales type lease because there is no difference between the fair value of the loader and Caterpillar's cost. Caterpillar is going to record the lease of the asset and the resulting receivable on January 1st, 2017 as follows. They received $25,981.62. We remove the executory costs of $2,000 for property taxes to show a payment net of executory costs of $23,981.62. We use the present value factor of interest at 10%, time at 5 years. We multiply that by the factor of 4.16986 to give us a lease receivable of $100,000. We then credit equipment $100,000. We use the lease amortization schedule. Notice it's very similar to the one that we used for the lessee. To recognize what portion of the payments will be executory costs, will be interest at 10% on the lease receivable, and then the lease receivable recovery. So that is the payment towards the amount towards the principal of the lease receivable. On January 1st, 2017, they record the receipt of that first year's lease payment as cash of $25,981.62. They have lease receivable of $23,981.62. And we have property tax expense or property tax payable, just depending upon how they're managing their books, of $2,000. On December 31st, they have to recognize their interest revenue from the first year. They have interest receivable of $7,601.84, and then interest revenue of $7,601.84. When they receive that payment on January 1st, 2018, they would have an increase in cash of $25,981.62. They would reduce their lease or their interest receivable, $7,601.84. They'd post to property tax expenses are payable, $2,000, and then they would reduce the lease receivable by $16,379.78. Here we're showing the assets section as it would relate to the lease transactions on December 31st, 2017. At the end of that year, there would be $7,601.84 that we expect to collect within the next year, so it's a current asset, and $16,379.78 that we expect to collect on the lease receivable in the next year, so that's current, leaving the remaining balance of the lease receivable at that point in time as a non-current asset, typically investments. So when they receive the payment on January 1st, 2018, here's that entry that I spoke to you about. And they would continue this for each of the years of the remaining term of the lease. They accrue their interest on December 31st. On January 1st, they would collect that interest along with the executory costs and the reduction to lease principal portion of the payments. A lessor should account for an operating lease using the operating method. Underneath the operating method, each rental receipt of the lessor is recorded as rental revenue on the use of the item carried as a depreciable asset. The asset is depreciated in the normal manner, with the depreciation expense of the period being matched against the rental revenue. So let's assume that Caterpillar accounts for this lease as an operating lease. It would record the cash rental receipt as cash at $25,981.62 and rental revenue of $25,981.62. Utilizing straight line depreciation over 5 years, they would have a depreciation expense of $20,000, and they would have accumulated depreciation, probably to equipment, of $20,000. Finally, we're going to talk a little bit about the special features attached to some of the lease arrangements. Those include residual values, sales types, leases, bargain purchase options, initial direct costs, current versus non-current classifications, and disclosures. There are certain characteristics to leases that create some unique accounting problems. These are some of those issues. The residual value of a leased asset is the estimated fair value of the asset at the end of the lease term. The residual value could be guaranteed or it could be unguaranteed by the lessee. A guaranteed residual value is said to exist when the lessee agrees to make up any deficiency below a stated amount in the value of the asset at the end of the lease term. A guaranteed residual value affects the lessee's computations of the minimum payments, and therefore the amounts capitalized as a leased asset and a lease obligation. The lessor assumes the residual value will be realized at the end of the lease term, whether it's guaranteed or not. To understand the accounting implications of a guaranteed residual value, let's assume that a lessee guarantees the residual value of an asset will be $8,000. At the end of the lease, the fair value of the residual value is actually less than $8,000. The lessee then will have to record a loss and make a payment for the difference. If the lessee depreciated the asset down to its residual value of $8,000, but the fair value of the residual value is actually $5,000, the lessee would then have to record a loss of $3,000. If the fair value of the asset exceeds the $8,000, a gain may be recognized. Gains on guaranteed residual values may be apportioned to the lessor and the lessee in whatever ratio the parties initially agree on. So let's look here at Caterpillar. We use the same thing, except for now we have an estimated residual value of $5,000. Remember before there was none. Caterpillar assumes a 10% return on investment, whether the residual value is guaranteed or unguaranteed. So they compute the amount of the lease payments by starting with the fair value of the lease asset, then less the present value of residual value. So that is 5,000 times present value factor of 0.62092 to come out at $3,104.60. So the amount that has to be recovered by them through lease payments is $96,895.40. There are going to be 5 periodic lease payments. We go to the present value of an annuity due and find the factor of 4.16986, divide that into $96,895.40 of recovery payments to determine amounts for each payment of $23,237.09. Now we're going to look at the computation of the lessee's capitalized amounts, assuming a guaranteed residual value. So from Sterling's capitalized perspective, the present value of those rental payments is $96,895.40, and then we add the present value of the guaranteed residual value of $3,104.60 for a capitalized amount of $100,000. Sterling will create the following lease amortization schedule. It's using effective, and we start with the lease liability of $100,000. All of our payments plus our guaranteed residual value are accounted for in the first column. We know the executory costs have to be reimbursed for property taxes of $2,000. And then we have the interest component. This is 10% of the prior carrying value of the lease liability. And then what remains of the payment goes to the reduction of the lease liability, changing the carrying value for the next period. At the end of the lease term, before the lessee transfers the asset back to Caterpillar, the lease asset and liability accounts would have a $5,000 balance in them. That would be $100,000 of leased equipment, less accumulated depreciation on the capital leases of $95,000. And then we would have an interest payable and a lease liability totaling $5,000. Now we're assuming that Sterling depreciated the lease asset down to its residual value of $5,000. But the fair market value of the residual value at December 31st is actually only $3,000. They need to make this entry of a loss on the capital lease of $2,000. We would have our interest expense. We would have our lease liability. We would have accumulated depreciation on the leases. And then we would have the leased equipment to bring this to the cash payment of $2,000 related to the residual value. Now we're going to assume those same facts, except that that $5,000 value is unguaranteed. Caterpillar is going to recognize the same amount through the lease rentals. That is $96,895.40. Sterling would capitalize instead of $100,000, $96,895.40, because it's unguaranteed residual value. We would use this lease amortization schedule, and as you can see, instead of going to $100,000 and having that $5,000 guaranteed residual value at the end, it only runs off the initial capitalized amount of $96,895.40. Now, at the end of the lease term, before Sterling transfers the assets to Caterpillar, the balances should be at zero. There should be nothing left for depreciation attached to the lease equipment. There should be no liability left. Here we have comparative entries for the differences between guaranteed residual value and unguaranteed residual value, and how those can impact the same situation. From the lessor's perspective, with residual value, the lessor is going to operate on the assumption that it will realize that value at the end of the lease term, whether it's guaranteed or unguaranteed. Assuming a direct financing lease with a residual value, either guaranteed or unguaranteed, of $5,000, Caterpillar is going to determine the payments by taking the fair value of the leased equipment less the residual value, its present value, to determine the amount to be recovered. There will be 5 equal payments yielding a 10% return. So we go to table 6.5 and we divide that $96,895.40 by the factor of 4.16986 of $23,237.09. From the lessor's perspective, it is assumed, whether the residual value is guaranteed or not, that it is a factor. So the entry on January 1st, 2017 for the first payment of $25,237.09 would be, on January 1st, 2017 would be a lease receivable of $100,000, and then we have equipment of $100,000. Now, the entry for the receipt of the cash of $25,237.09. I was a hair ahead of myself there. My apologies. Would be $23,237.09, reducing the lease receivable, and $2,000 posting to property tax expense or property taxes payable for the executory costs. December 31st, 2017, we would have the accrual of interest in the amount of $7,676.29, which we would post to our lease receivable, and we would reduce our interest revenue. We would increase our interest revenue for the 2017 fiscal year. So residual values are really kind of important because they help determine how much is going to be recovered, what those lease payments are. The next thing we're going to talk about is those sales type leases. So in a sales type lease, the lessor records the sales price of the asset, cost of goods sold, and related inventory reductions, and the lease receivable. The primary differences between a direct financing and a sales type lease is that manufacturer's or dealer's profit or loss. And there is a difference in accounting for the guaranteed and unguaranteed residual values. Under the sales type lease, the profit is recorded by the lessor at the point of sale is the same, whether the residual value is guaranteed or unguaranteed, but the sales revenue and cost of goods sold amounts are different. The present value of the unguaranteed residual value is deducted from sales revenues and costs of goods sold. Underneath sales type leases, we have a variety of terms that you need to be aware of. There's the lease receivable, which might also be referred to as the net investment. This is the present value of the minimum lease payments plus the present value of any unguaranteed residual value. The lease receivable therefore includes the present value of the residual value, whether guaranteed or not. There's the sales price of the asset, which is the present value of those minimum lease payments. And then the cost of the asset to the lessor, less the present value of any unguaranteed residual value, represents the cost of goods sold. So to illustrate a sales type lease with a guaranteed residual value and with an unguaranteed residual value, we're going to assume the same facts as we have been using. The estimated residual value is $5,000. The present value of which we've already calculated is $3,104.60. The leased equipment has an $85,000 cost to the dealer Caterpillar. We're going to assume that the fair market value of the residual value is $3,000 at the end of the lease term. So computation of the lease amounts by Caterpillar, who's the lessor on a sales type lease. There would be a lease receivable, whether there is guaranteed residual value or unguaranteed residual value, in the amount of $100,000. The sales price of the asset, though, is going to be different. Underneath the guaranteed residual value, the sales price is $100,000. Whereas underneath the unguaranteed residual value, it is only $96,895.40. That is the fair market value of the lease payments less the fair market value of the unguaranteed residual value. Cost of goods sold underneath the guaranteed residual value equals the actual costs of the organization, whereas cost of goods sold when there is an unguaranteed residual value is the difference of the cost of goods less the the present value of the unguaranteed residual value. In either situation, the gross profit dollars is the same, because when we take the $96,895.40 and reduce it by cost of goods sold of $81,895.40, we reach $15,000. And $100,000 less $85,000 is $15,000. Here we have for you an illustration of all of the journal entries and how they compare between guaranteed residual value and unguaranteed residual value. A bargain purchase option is a provision that allows the lessee at his or her option to purchase the lease property at a price that is sufficiently lower than the expected fair value of that property at the date that the option becomes exercisable. When a bargain purchase option exists, the lessee must increase the present value of the minimum lease payments by the present value of the purchase option price. The only difference between accounting for a bargain purchase option and a guaranteed residual value of identical amounts is in the computation of the annual depreciation. In the case of a guaranteed residual value, the lessee is going to depreciate the asset over the lease life. When a bargain purchase option is present, the lessee uses the economic life of the asset in computing that depreciation. Moving on to what's called initial direct costs. These impact the lessor. The initial direct costs are the costs incurred by that lessor that are directly associated with negotiating and consummating a completed leasing transaction. There are two types of initial direct costs. There is incremental direct costs, and then there are internal direct costs. Incremental direct costs are incurred in originating a lease, arrangement that are paid to third parties. Internal direct costs are costs directly related to specific activities performed by the lessor on a given lease. When an operating lease is present, the initial direct costs are deferred and amortized over the life of the lease in proportion to the rental income. Sales type lease, these costs are expensed in the period that the profit on the sale is recognized. For direct financing leases, initial direct costs are added to the net investment in the lease and then amortized over the life of the lease as a yield adjustment. Keep in mind that there's going to be a portion of the liability or the asset that is going to be current. It's those amounts that are going to be due in the next period, the next year, where the rest is going to be classified as non-current. So take a look at this particular illustration, and what is the current portion of the lease liability receivable, or receivable depending on which one of the entities you're going as the perspective from, for December 31st, 2017. You should have $18,017.70 as the current portion. The disclosure requirements for lessors and lessees are going to vary depending upon the type of leases that are at play. The required disclosures provide investors with some general information here. general description of the nature of the leasing arrangements, the nature, timing, and amount of cash flows in and out associated with those leases, including payments to be paid or received for each of the 5 succeeding years, the amount of the lease revenue and expenses reported in the income statement each period, descriptions and amounts of leased assets by major balance sheet classification and their related liabilities, the amounts receivable and unearned revenues there might be underneath lease arrangements. In practice, the strong desires of lessees to resist capitalization have rendered the accounting rules for capitalizing partially ineffective. The lessee's use of the higher interest rate is probably the more popular subterfuge. The residual value guarantee, if the other unique yet unpopular device, is used by both lessors and lessees. To avoid leased asset capitalization, some companies will write and interpret their lease agreements intentionally to prevent satisfying any of the 4 capitalized lease criteria. Because remember, that group 1, those 4 criteria are in common for both parties. The real challenge actually lies in being able to disqualify the lease as a capital lease to the lessee, while having that same lease qualify as a capital lease to the lessor. Unlike lessees, lessors try to avoid having lease arrangements classified as operating leases.